Hey guys, what's going on? Welcome back to Stocks with Sorfing. Today, we're going to be investigating the 15% crater in Amazon stock to see if this is a trap or potentially a massive opportunity. So, Amazon just wiped out $200 billion in value, and now it's testing the $200 support level after a brutal earnings sell-off. On one hand, the growth is there. AWS just hit its fastest growth in 3 years, and their AI business is now a $10 billion powerhouse. But I'm holding off on buying because we need to look at the massive spending shock in their 2026 forecast that has Wall Street terrified. And we're breaking this down right now to see if it's actually a good time for me to be starting a position. So why did the market just wipe $200 billion off of Amazon's valuation? Well, it comes down to a spending shock. Management just announced a staggering $200 billion capital expenditure plan for 2026, a 60% jump from the last year. They're essentially betting the house on AI infrastructure and satellites. And well, it caught Wall Street completely off guard. The big concern here comes from free cash flow. Investors are terrified that Amazon is shifting from a cash printing machine to a money pit, with some analysts predicting that they could actually see negative cash flow this year, even though Amazon Web Services is growing at 24%. The market is worried that Amazon is overspending just to keep up with Microsoft and Google. We need to figure out if this is a visionary move or just a desperate, expensive race to stay relevant. So next, let's take a look at the actual business model of Amazon. So let's start by taking a look at Amazon Web Services. Now, this is the backbone of the internet. Amazon owns massive data centers globally and rents out computing power and storage to everyone from Netflix to the government. Lately, they've started building their own AI chips to handle the massive processing power required for the next decade, making them a tech manufacturer as much as a service provider. Next, let's take a look at the high margin stuff, advertising. This is where Amazon uses its data because they know exactly what you buy. Brands pay them billions to put their products at the top of your search results. They've recently expanded this into Prime Video, meaning they're now a major player in the global digital ad market alongside Google and Meta. Next is their logistics. Amazon has pivoted from being a store that sells its own items to a logistics utility. They allow independent sellers to list products, and for a fee, Amazon handles the storage, packaging, and the shipping. They essentially own the pipes of global commerce. Next, they have subscription services. This is Prime. By bundling fast shipping, streaming movies, and music into one fee, they create a lock-in. Once you're a Prime member, you're far less likely to shop anywhere else, which keeps the whole machine spinning. Next up is, the online store. This is the original everything store. While it's the most mature part of the business, it serves as the giant front door that brings hundreds of millions of people into the ecosystem. So the other more profitable segments can take over. So now let's take a look at the revenue growth by business segment. So first is AWS. It grew at 24%. This is the ultimate comeback story. After a period of slowing growth in 2024, AWS has re-accelerated to its fastest pace in years. The trajectory here is vertical because of the AI gold rush. With their custom Trainium chips here becoming a viable alternative to NVIDIA, AWS is moving from being just a storage provider to being the essential factory for the AI era. Next, we have advertising that grew at 22%. This remains the hidden powerhouse. While it's the second fastest growing segment, it is likely the most profitable. The trajectory here is moving beyond just sponsored products and into Prime Video ads. Amazon is effectively turning its massive viewer base into a high-margin cash machine that fuels the rest of the business. Next, we have the third-party seller service, and that saw 19% growth, which is still really good. The segment represents the fees Amazon charges third-party sellers for shipping and fulfillment. The trajectory shows Amazon successfully pivoting away from owning the inventory to becoming the world's most essential logistics utility. They're making money on every step of the package's journey, regardless of who sold it. Next, we have the subscription services that grew at 11%. This is the lock-in segment. Growth is steady and predictable. The trajectory here is focused on increasing the stickiness of Prime by adding more exclusive content and services. They ensure that the 300 million global members stay in the ecosystem, providing the floor for the entire company's revenue. And then finally, we have the online store that grew at 8%. Slow, but honestly still pretty steady. This is the most mature part of the business. While 8% looks small compared to AWS, it's coming off a massive base. The trajectory here is no longer about hypergrowth, it's about efficiency. This segment is the face of the brand that brings customers in so that they can be monetized by the high growth segments like ads and Amazon Prime Video. So let's start assessing Amazon based off some key fundamentals to see how financially healthy this company currently is. Let's start with gross margins at 49.2%. This is the profit that Amazon makes after paying for the direct costs of goods and services, but before the massive 2026 spending on data centers and employees. This metric is at an all-time high, up from 46% last year. It proves that Amazon is successfully transferring from a package company into a software and services company. Since high margin segments like AWS and advertising are growing faster than retail, the overall quality of every dollar Amazon earns is improving. Next, let's look at the operating cash flow at $139.5 billion. This is the actual cash generated by the business's operations. This is the gas in the tank. Despite the stock price drop, the core engine is firing on all cylinders, growing at 20% year over year. This tells us the business isn't broken, people are still shopping, companies are still using the cloud, and brands are still buying ads. The cash is flowing in faster than ever. Next, let's look at the net cash position, and it's something that I like to look at personally. This is like a safety net. And they're currently sitting on $46 billion in total cash and short-term investments minus their total debt. This is the ultimate health check, as Amazon has a negative net debt, meaning they could write a check and pay off every single loan they have tomorrow and still have $46 billion sitting in the bank. This gives them the freedom to spend $200 billion on AI without needing to beg Wall Street for loans. Next, let's take a look at free cash flow, and there does seem to be a little bit of a red flag here. So, free cash flow is the money that's left over after the business pays all its bills and pays for all its new equipment. This is why the stock is down. Free cash flow has plummeted from nearly $40 billion down to $11 billion. When investors see cash flow drop, they panic. However, our investigation shows this isn't because the business is losing money, it's because they're intentionally dumping $50 billion more into AI infrastructure than they did last year. Now, the last one I want to look at here is the interest coverage ratio. Now, this isn't one that I like once again just for assessing debt on the company, and it basically is a measure of how easily a company can pay the interest on its debt. And while the interest coverage ratio is sitting at 36.4, that means that for every $36 that Amazon makes, it only costs $1 of that to service their interest, meaning that their balance sheet is a bit bulletproof and a real fortress. Now let's take a look at the bear cases for Amazon. So the first one has to do with the negative cash flow trap. Now, the most immediate fear is that Amazon is about to become a net loser of cash. Analysts at JP Morgan and others are forecasting that this $200 billion spending spree could push Amazon's free cash flow into negative territory for 2026. Well, Wall Street loves Amazon because it became a cash printing machine over the last 2 years. Half that cash disappears into data centers and satellites. The stock loses its safety status. Investors hate seeing a company go from making $50 billion in cash to losing money on operations just to stay relevant. The second is that they could be losing the lead, and now they could be scrambling to catch up. There is a growing narrative that Amazon actually fell behind Microsoft and Google in the first round of the AI war. D.A. Davidson recently downgraded the stock to hold, claiming Amazon is losing its lead in the cloud. Bears argue that $200 billion isn't a visionary investment, it's a desperate scramble. They believe Amazon is overpaying for chips and data centers now because they were too slow to build them in 2024, and that they are essentially running to stand still while their competitors who have better AI partnerships like Microsoft and OpenAI are taking higher value customers. The final one I can think of here is the return on investment. The core of it is building a data center takes years, and buying gigawatts of power takes years. Bears are worried about capex fatigue. They see spending increase by $600 billion in a single year, but they don't see revenue growing at 60%. If the demand for AI models slow down, or if companies find they don't actually need as much AI as they thought, Amazon will be left with a $200 billion worth of digital paperweights that they still have to pay to maintain and cool. So now let's try and put a valuation on Amazon. Let's start by looking at the PE ratio that's currently 28.8x. This is the trailing price to earnings ratio looking at the last 12 months of actual profit. For context, Amazon's 5-year average is closer to 45x. By hitting 28x, the stock is now trading at a valuation usually reserved for something like a retail company, despite the fact that Amazon is currently a high-tech AI leader. This research suggests that the market has sucked out all the hype and is now pricing it on pure fundamentals. The forward PE now is 27x. This looks at the expected earnings for the rest of 2026. Because the forward PE is lower than the trailing PE, it tells us that analysts expect Amazon's earnings to continue growing even with that massive $200 billion spending plan. The E, earnings in the math, is expected to outpace the spending, which is very bullish signal for long-term health. Now let's take a look at the PEG ratio. It's currently sitting at 1.45. This is the price to earnings growth ratio. It's the ultimate metric for companies like Amazon because it adjusts the PE ratio for how fast the company is actually growing. And for PEG ratio, typically anything above 2 is considered extremely expensive and anything under 1 is considered a deal. So right now, it's priced reasonably. It's not overvalued, but it's definitely also not trading on a sale according to PEG ratio. Next, we have the EV to EBITDA trading at 15x. This metric is enterprise value to EBITDA, is what the big money hedge funds look at. It accounts for both debt and cash while looking at raw earnings power. At 15x, Amazon is trading at a significant discount compared to its historical average of 18. If Amazon were to simply mean revert back to its normal 18x multiple, it would imply a stock price of approximately $258, giving us a massive upside from the current around $208 support level that we're currently seeing. So that's the video on Amazon. To be honest with you, I'm not going to add it to my portfolio yet because I think the market's in a little bit of a weird spot right now. But if this stock continues to drop, I'm definitely going to consider picking it up because honestly, even with the AI spending, this is an extremely healthy company that will continue to create value for shareholders for an extremely long time. And in this video today, we didn't even touch on what they're doing with robotics. That's also extremely impressive as they continue to replace people with robotics, which is not a great thing. I don't advocate for that, but it's going to continue to put the margins up, especially in the retail business. Since that is turning into more of an efficiency focus, that will continue to help. So for now, I'm going to hold off, but this is definitely a stock that I think is interesting, and I might add to my portfolio soon. It could do a pretty good job at replacing something in here like Constellation Software that I'm thinking about leaving. Since it does have a little bit of a software side, it gives me the diversity in that way. So I hope you guys enjoyed. If you did, please subscribe.